Welcome to Global Tax Talk. I'm Will Morris, and I'm delighted to be joined today by my colleague, Eugen Trombitas, who is one of my tax policy colleagues who deals with indirect tax, excise taxes, customs duties, all the rest of these things. A huge field. So, Eugen, otherwise known as ET, welcome.
Thanks, Will. It's great to be with you.
Good. So let me ask you a question. With Pillar 2, one of the things which has come into the spotlight is transfer pricing adjustments, which are made at the year end. And countries can differ on this quite widely as to how these adjustments affect indirect taxes, such as VAT and customs duties. So could you just give us a high-level sort of overview of what's going on?
Very happy to, Will. Look, you're right. TP adjustments are in the spotlight, but in particular, what are the indirect tax consequences arising out of those? And so to drill into that, I think the first marker that we can put down is, what are we talking about? What is the TP adjustment after year end? And there are a number.
Yep.
So you can have TP adjustments that look to achieve a certain guaranteed profit margin or a profit split in a JV type scenario. Or actually after a tax audit, you might have to adjust for the consequences of that audit to follow the TP rules. And then because of the contract, there may be price adjustments to either goods or services. So that's what's going on. And some of those adjustments can actually give rise to indirect tax consequences, right, believe it or not.
Yep.
And other adjustments may not. So I'm going to cover that off in some detail.
Good. So, I mean, as you say, let's get a little more granular on this. So how are countries addressing the situation? And could you give us a few examples of unique requirements across various jurisdictions? Absolutely.
So the reason why this is actually in the spotlight is for a number of reasons, but in particular because of the Pillar 2 filings and Amount B rules. So that's sort of a vibrant state of change, as I'd put it to you, and we've talked about that before in terms of the international tax rules. And there's actually 5 European court cases on this going to the next level. So there's a lot of litigation in this area in both goods and services in a number of industries. So companies need to be absolutely mindful because customs authorities are thinking about it. So the first thing is to try and differentiate the customs and the VAT consequences in terms of general principles, and then maybe I'll give a few examples. Yep. So on the customs side, typically we're not worried about services. We're concerned about imported goods, right, and I'll cover that off in the country examples. But when it comes to VAT, the central thing from a VAT point of view is there consideration for a supply?
Right.
And this is getting at price adjustments. So if I'm related party number 1 and I make a TP adjustment payment to you, Will,
right,
and you're related to party 2, so I've just converted us into related parties and it's cross-border.
Yep.
The question from a VAT point of view is that, is my payment or price to you moving value back to me in the form of goods or services? So that's a central thing that we look for in VAT, and a number of the TP adjustments just don't matter. We say it's out of scope. Mm-hmm. So the guaranteed profit margin, profit split, things that are done after tax audit to follow the tax rules, out of scope. But actually, if the contract says you're paying me a price for goods or services, then that does matter.
Right.
And so the way this plays out in a number of countries is different, similar but different, all at the same time. And to illustrate with imported goods and back to customs, but import VAT is also relevant. So in the EU, there's been varying interpretations. So thank goodness for this case law. Right. In some respects, that's a positive. We'll get a bit more clarity. And there's also differences in terms of how do you actually report the adjustments. Yep. So some countries allow in the adjustment period, others throughout the year. Then you move to China, so moving to Asia, a very strict jurisdiction. So anything to do with an upward adjustment, right, or I'm paying you rather than you paying me, has got to be pre-disclosed in China before you make the payment. And there's other regulatory bodies who are interested in that, and it can take up to 6 months for that to be approved. US, a jurisdiction close to your heart, indeed, no VAT. There can be duty, but even if there's no duty, US Customs requires reporting of both upward and downward adjustments. Okay. Best practice to avoid penalties. And then closer to home, where I've practiced before in Asia-Pac, Australia, typically you would do a voluntary disclosure letter to Australian Customs, and then New Zealand operates a provisional value scheme, which is really good. Goods are landed on a provisional value, and then later you true up or true down to the final value, and the rules are well understood. And I actually do like the provisional value scheme because everyone knows what the ground rules are, and then you can build that into your process.
Right.
And then Mexico, just finally on country differences, has a really good, effectively a global return for imports. It covers both VAT and customs. Really fantastic, simple procedure.
So, long story short, lots of different procedures in lots of different jurisdictions, and
Absolutely.
keeping on top of this is not
Absolutely.
easy. So, in terms of the keeping on top of it, what are leading tax functions doing then to address this issue, and what are some actions that companies should really be thinking about?
Well, apart from staying alert, I think I would endorse three key things. The first one is look, be proactive, and if in doubt, seek advice internally or with advisors, or even talk to customs. So being proactive is number one. Number two, really good tax functions. The tax team is talking to the supply chain team, particularly if there's anything to do with imported goods or procedures at the border that could hold up goods at the border, or the procedures, even inadvertently or innocently are not well understood in the business. It's important for the tax team to be talking to the supply chain team.
Right.
And then finally, if a country does operate a simplified procedure, e.g. Mexico that I mentioned, or a provisional value scheme, build that into your process, and then hopefully you'll have a bit more peace and comfort.
Great. Well, look, E.T., thank you very much for these insights. A lot going on here, and a huge amount going on in the indirect tax world and customs and tariffs. So we will get you back very soon. But thank you very much for joining.
Thank you, Bob.
And thank you for joining us. And come back next time so that you stay global tax ready.